In panel A, the blue line reflects the conservative investment approach, while the red line captures the aggressive investment approach. By looking at the figures, we can derive the following lessons. Under a conservative investment approach, a sovereign wealth fund can act as a fiscal buffer. To see this, recall that commodity prices are assumed to be on a downward trend. As a result, natural resource revenues are enough to finance the conservative investment path. How do we know this? Because when adopting a conservative investment approach, the government must withdraw savings from the sovereign wealth fund, as represented by the blue line in panel B. But these savings turn out to be enough to maintain the public investment plan without resorting to new debt issuance, panel C, or increasing taxes, panel D. Instead, when adopting an aggressive investment approach, the government needs to implement a fiscal adjustment at some point and accumulate debt, which may lead to undesirable debt dynamics. Under the aggressive approach, the government runs out of savings at year 9. See the red line in panel B. Then it follows that to maintain the aggressive investment plan, it needs to issue new debt, panel C, and increase the tax rate, panel D, at some point. And given what we learned in the previous section, strict constraints on VAT adjustment make the aggressive approach more susceptible to induce explosive debt dynamics. These tax and debt effects contrast with those of the conservative approach mentioned before. Note also that the aggressive approach causes a higher level of non-resource output, panel E, and a higher level of private consumption, panel F. However, higher debt and taxes affect negatively private consumption, and as a result, the increase of consumption is very similar to that of the conservative approach at the end of the simulation period, panel F. A final lesson that we can draw from this example is that by saving part of the natural resource inflows in a sovereign wealth fund, the government can help mitigate Dutch disease effects. These are effects related to the real exchange rate appreciation and losses in the non-resource traded sector, which arise from the inflow of foreign currency derived from exports of natural resources. Note that the real exchange rate decreases by more, and therefore it appreciates to a larger extent under the aggressive approach than under the conservative approach. See panel G. This is because, under the aggressive approach, the government saves less in or withdraws more from the sovereign wealth fund. Consequently, during the first decade, output in the non-resource traded sector decreases by much more under this aggressive approach than under the conservative approach. Panel H.